Okay. I'd like to call the meeting to order for, the city's pension board and ask for a roll call, please.
Jim Hendrickson here. Jared Schmidt here.
Frank Nash,
Dave Kramer.
Rich Baskin.
thank you very much. I apologize.
It's okay, Frank.
Okay.
That's not the worst you've done to me.
And minutes, acceptance of the minutes from the regular meeting for March 12th.
So moved. Second.
All in favor?
Aye.
And then the divine contribution minutes from January 8th, 2022.
I'll move to approve the minutes.
Second it.
Second.
All in favor?
Aye.
Thank you very much. Is there any public comment? If there's no public comment. We'll move on to pension applications. Now, there weren't any listed, but however, in the March meeting, there was the Darlings was
Set aside, yeah.
set aside, table. And so I was just wondering if we could get an update on that, if there's anybody to update
And do
us.
we wanna do that in executive session?
So I think I can give an update without having to go into executive session, and we're looking into it further. We have our attorneys, looking at the request, and, we just need a little more time. We got an initial, response from them that wanted them to go a little bit deeper. Just because whatever the resolution is and whatever the decision is gonna set a precedent for a future, so we wanna make sure we get it right.
I have an old contract book from the city. And I don't know whether it's been changed or not, but one of the things it does say in there is that the pension board's decision is final. So, so I think that, there have been cases where people actually did bring in an attorney. And I don't know whether that would be a possibility or not. Obviously, if the consensus is that it's approved, then I don't know if that would be the case, but anyways, I just wanted to make you aware of that.
Yes, and I think that's usually the case, so if we have to go into executive session, that the person making the claim would be allowed into it with
Right.
with representation.
Yes, I would agree that we would go into executive session on that. You want to go now to Empower is here. Do you want to do Empower now?
If that's okay. Yeah. Great. So Empower is just going to present a review of defined contribution and deferred compensation plans. And some of the usage patterns that they're seeing. Do you mind, Guy? Thanks.
Do you want to bring that thing up about the change of the contract or not?
I don't think. I don't think
Okay.
you should. Maybe we take it offline and have a discussion and then we can engage with them.
The school board still has all the different places with money. We ever hear about that?
Okay, wanna wait for this one?
Thank you very much. Motion to keep our feet dry.
All right. Like the train, Frank. You can't leave your bags on the.
Hey, listen, this bag,
Chair.
my kids gave me this bag when they were 4 years old and now they're 50. And that's the reason why I have it, and I'll even show you.
Never lost it.
They love it because look at this, it's got all these little pouches and stuff like that. So,
Do we need to connect anybody via video or anything like that? Or no? Okay.
We're all connected.
So handout for everybody here. Just like to
Thank you.
Hello, everybody.
Hello, hello.
Everybody doing today? Thanks for coming ahead to us. Very, very happy to be here. Appreciate the opportunity to come. Came down from New Haven, so not far. It's very easy for me to get here. And the traffic gods are in my favor today.
Nice.
What I hope to do today is just kind of take a look at a couple of things. What I like to do with my clients is kind of bring out some plan demographics, plan analysis of the deferred compensation plan and the 401A money purchase plan. Take a look at some of how the participant behaviors are. And then talk about some things, get your idea of some things that maybe we should be looking at from a plan perspective standpoint, from a fiduciary standpoint, and find out what's kind of on your mind and things that you might want to do to improve it. So in front of you is information that we ran on both the deferred compensation and the 401A money purchase plan. And, you know, the first page is just an opportunity to talk about the team that services the city here. There's four of us who are kind of dedicated to servicing the city employees. My boss, Rob Luciani's 37 years of experience in the record keeping business. I'm the Brendan Walsh, the relationship manager of 35 years. Before coming to Empower 3 years ago, I spent most of my career with TIA managing the retirement plans for the higher ed and private K-12 schools. Your wife may be very familiar with that from Hopkins. And then RJ Nowak works with the team here on administrative, day-to-day kind of administrative processes, make sure everything is running smoothly. And then some of you may be familiar with Daryl Wells, who comes out and does the individual counseling for the participants. He does a lot of work with the police department as well here.
Who's from Boston?
Uh,
Isn't he even from Boston?
no, Daryl's from Hamden. There may have been somebody from Boston at one point in time. So from the agenda standpoint, just looking at some plan statistics and benchmarking. I want to briefly cover how we communicate with the employees, because there's a lot that goes on in terms of sharing information with employees about how to invest in the markets and things like that you don't always get to see. And then talking about Secure Act 2.0. So from a fiduciary standpoint, there's been several regulations that have been put forward from the government regarding the Secure Act. Most of them are optional, but a few of them I want to make sure that everybody is fully aware of, that they will impact the administration of the plan. And then finally, talk a little bit about some of the initiatives that you may have on your mind. So if you turn to the executive summary page, this is just the deferred comp plan. So I'll cover the deferred comp plan first and then briefly talk about the 401A. And the reason I'm doing that is the 401A plan, you'll see, doesn't have as much activity. Most of the participants in there are in the target date series. So there's less selecting of the investments happening in that plan. So the assets, and this is as of the end of February when I produced this report, a little over 55 million in assets in the deferred compensation plan. Anybody want to guess what it was as of yesterday? Less, correct, 50 million. Now, what it'll be tomorrow when I open it up, it'll be a different story, we'll know, but it was 55 million. And if we look back across the last 4 years, so it's 55 million. Back in 2022, the assets were 46.8 million. 2023, 43.5. And as you see, as we go along here, in terms of participants with a balance, there's 451 participants in deferred compensation plan, of which 392 are active with a balance. When people separate from service here, they're not required to take a distribution from the plan immediately, so a lot of people will keep the money in the plan. They like the investment lineup and they choose to stay in there.
I have a question. You know, was the, from February 22 to 23. Were you surprised at that decline? I mean, the market was a little lower. Did funds change much coming in and out of the?
We'll take a look at that. There was one year where there was a higher number of distributions. I think last year there was about 6 million that came out in distributions compared to what's on average about 3 million. We'll take a look at that. That's coming up in a slide. Next slide talks about the average balance on the left-hand side. Average balance of 122,202. That's well above the benchmark. We benchmark governmental plans like this, so you'll see that the average balance here is significantly above the benchmark. It falls below the top 10% of the benchmark, but still overall a very good average balance. And you'll see that average balance increased by 22,000 over the same time period back in 2022. In the middle is how we look at how people are investing in the plan. So I'll start with the target date strategy. 63.9, almost 64% of the deferred compensation folks are using the target date strategy. That's the American funds that I'm sure Britt recently just went through with you. Do it yourself strategy, 23.1. So that's how we categorize folks who aren't in a target date and aren't in a managed account solution, but they're selecting from the investments and choosing the investments either on their own, with an advisor, working through one of our counselors. The My Total Retirement 13.1, that's a managed account solution. So these are people in the plan who are signing up and paying a fee for a managed account solution. And we'll take a look at those numbers. That number is growing significantly since it's been introduced. But 13.1% of the participants are in that.
Is that based on new money this year, or that's if they ever did certain things?
It's as if it's when they signed up for it. So you can go in at any time and sign up and say, I want to have this professionally managed.
But how about even like target date strategy? That's based on what they're doing this year, basically.
That's what they're doing currently.
Currently. And then, okay, and do yourselves what they're doing currently then.
That's correct.
And at this stage here.
That's correct. And again, when we look at the 401A plan, you're gonna see a significantly higher number of people in the target date series.
Yeah.
I think it's around 80 to 88 or 89%.
And my total retirement, that's a custom portfolio for the person, that's what that is?
Yes, it is.
Using the options in the fund line.
Correct, using the options in the fund lineup. What the fee for that is, it's 50 basis points on the first $100,000 that is being managed. And then it goes down 40 on the next 150,000, 30 basis points on the next 150,000. And folks can opt out at any time. They opt in, when they opt in, they're familiar with the fees are, we disclose all of that, and then they
And
can,
what's the fees for target date strategy?
based on what the expense ratio of the funds are. So
Is it near 50 basis points or no?
it's much less than that.
Much less. But I would just remind everyone that when the new lineup was rolled out and Empower was hired, participants were defaulted into the target date funds. And, you know, we have different trackers in terms of allocation and DC plans. I'd say large corporate 401k plans, the average target date fund allocation is 30-35% of participants. So, but this we view very favorably
Yeah.
because diversified portfolio that will de-risk as they get closer to retirement. So we think it's positive.
On the right-hand side, so again, allocation by asset class, so 61, almost 62% asset allocation, 24.4 in large cap, and then you see, you know, down the line, small cap 2.1, 2.7 in stable value.
What's the first, what's the asset allocation, what is that?
That's gonna be your target date
Target
strategy.
date fund itself, that's what that is.
Correct.
Maybe we'll get to it, but are you getting any feedback on missing asset classes that people want?
We have not, no, we have not. Next page, so the participation rate. We have it 75% of the eligible participants are participating in this plan, which is fantastic. Benchmark is 57%, top 10% is 90%. Your contribution rate on average is 7.5, that's again above the benchmark. And you've got 27.2% of the participants contributing over 10% into this plan. And you'll see that again, the trend line in terms of participating over 10% is increasing year over year, as is the participation rate. If we look at the next cash flow, again, comparing the 4 years, you'll see that the contributions into the plan have remained, fairly in the range of the 3.7, 3.9 million in terms of contributions. But looking back over last year in terms of distributions, this is what I was referring to earlier, 6.059 million in terms of distributions last year, as compared to the previous years where it's usually around, 3.2, it was 3.8, and then later on 3.2. The plan does not offer any loans, and then you can see kind of the change in value from year to year.
The dip in in 22 to 23 was mostly investment.
Correct. These plans go by the way of the investments, right? Where people are, the bulk of the money is. And then contribution, we talked about the average is 7.5. The next slide just breaks it down by number of participants by contribution rate over time. So one of the things I think that's kind of exciting to look at is if you look at the last column, contributing over 11%. If we look at the same time period in 2022, there were 60 individuals who were contributing over 11%. That's now up to 85%, and it jumped by 13 people last year. And so people are increasing their contributions. When I look at most of my clients, one of the things I always try and focus on is the plan offers a Roth, the ability for employees to make a contribution on a Roth basis. I like to see a growing percentage of people who are contributing to Roth, especially the younger people getting the opportunity. They may not need the tax deferral now, but the benefits of getting tax-free at retirement and at a Roth is a very powerful thing. And as you can see here, if we look at contributions in March of 2024, there were 49 individuals contributing Roth. That number is now up to 68. So we added 19 people contributing on a Roth basis as opposed to a before tax basis.
Was there any education involved in that, or?
Yes, we do a lot of education on Roth. We do a lot of education on market volatility and all of that. And I'll have an opportunity to show you that.
Okay, I'm just wondering why it went up, that's all.
Yeah, it's
something that you did, or?
It is. I mean, we made a conscious decision to provide information to people on Roth.
If someone's in a pre-tax, they can switch over to Roth?
Yes. They can, and they can split it as well. So people can do, if they want to do some pre-tax and some Roth.
You can move money from a regular to a Roth. You have to pay tax on it.
Right.
Yeah.
But the other thing is, I think, isn't there a cap of like under 50,000 to have a Roth? There's a cap.
If you're talking about like on our Roth IRA,
Yeah.
there is an earnings,
Yeah.
certain salary. But with this, inside the plan, there is no cap. So you can do it. Well, let me rephrase that. There's an amount that you can defer into a deferred compensation plan. Like 23,005 if you're under 50. If you're over 50, you can do another 7,500 to that. And there's a new rule that came out as part of the Secure Act for people who are age 60 to 63. No one's been able to tell me why they decided on 60 to 63, but it allows those folks to do another $11,250. But that could be done pre-tax or Roth.
And the declining number of before tax participants, is that all due to
The Roth.
people going over to the Roth?
I would assume so, yes. On the next page is our distribution activity. This is just taking a look at, if we want to look at the rolling 12 months, so a 12-month capture period. There were a total of 95 distributions taken over the 12-month period. The bulk of them are separation from service, people separating from service and taking a distribution. There were 14 required minimum distributions, 4 hardship distributions, 3 divorce case distributions, and 10 death claims, total of 95 distributions. The RMD age has been increased to age 73. It is eventually going to go up to age 75 by the year 2033. As I was talking about earlier, we had a little brief conversation about the managed account strategy. Here's again, we break it down, but we're giving you, number of participants. So total of 59 individuals who are using the managed account solution. Representing 13% of the plan participants, plan's population. And then it represents 8.8% of the assets for a total of 4.8 million. The average balance using a managed account is 81,748. The average balance using the target date strategy is 101,329, and that represents 53% of the assets. And again, the do-it-yourself strategy, 38.3% of the assets, total of $21 million of plan assets, and the average balance is 202,954.
How many are in this plan? Only because 10 deaths seems high.
We have a total number of 451 in the 451 participants with a balance.
I'm thinking with the actual exposure. They were lower than that. I'm just curious, that's all.
And then the next page would simply break it down by active versus separated from service participants, if you're interested in seeing that. What I'd like you to do is switch to page 14, because I think this to me is always the most intriguing, one of the most intriguing slides. And it's looking at plan participants and their equity exposure. So if you bear with me a second, I'll kind of explain what we're looking at with this slide. So the slide is representing a glide path that you'd see with a target date series, right? Starts out more aggressive, more exposure to equities as folks are younger, and then over time balances out, fewer assets in equities and more in fixed income. What we've done is this point graph is taking all of the plan participants and mapping to where they fall on the glide path. And what I'm really excited about this plan, is if you look at the lower left-hand side of the graph, normally in governmental plans, we see a ton of people investing conservatively at young ages. For whatever reason, right? They want to be in the stable value fund, they feel safer in there, and they have their assets there. In this plan, we see almost nobody conservatively invested, having a bulk of their assets in fixed account or safe investments. On the right-hand side, upper right-hand side, we will see some people, there's a set, if you follow the graph on the x-axis, you got a 74-year-old. Moving up the y-axis, who looks like 100% of their allocation in equities. That's one of those things that makes us go, maybe we want to have a conversation with that individual. Now, person might look at it and say, well, I've got the pension, I'm in the pension, that's safe. I want to take more risk when it comes to the deferred compensation plan. But to me, this tells a really good story in terms of how your folks are understanding how to invest. And kind of making sure that they have good equity exposure, high equity exposure, almost 100% for people in their 20s and 30s. And then still keeping some equity exposure as they get older. So what this is telling us is the folks who are using the target date strategy, 81%, 81.3 are within that glide path. 99% are within 20 points of the glide path. And again, how somebody might be in there is if they selected, so let's say the age based on their age range, they should be in the 2050 fund. But they're like, you know what, I wanna be a little more aggressive than that. I'd rather be in the 2060 or 2065 fund. That's how that would work.
And the size of the bubble is the number of participants in that age group.
That's correct. That is correct. Okay, so then we take a look at the do-it-yourself participants, the folks who are selecting, they're not in a target date, they're not in a managed account, they're selecting these investments. So folks who are 50 or older, and what percentage of them, what age 50 or who have high equity exposure? So we're looking at, there's 24 individuals that came out between age 50 and 59 who have an average equity exposure of 89.3. We have 8 individuals between age 60 and 67 who have an average 91.7% equity exposure. So one of the things that we do as an organization is we'll send mailers out to these folks and encourage them to come in or sit down with Daryl and do an investment review to see if they're where they should be, want a little more education, etc. Some of them are perfectly fine being where they are, but we want to just make sure that they're aware of that. We also do it for plans where we find that some of the younger folks are too conservatively invested, but again, in your plan, we're not finding that. Okay. And then I'm sure you guys discussed this before I got here, but if you look at if we turn to page 16, it's the asset allocation by fund. These are the funds that are in your menu. Britt may have told you or informed you that we did they instructed us to add the next vintages of the American Funds Target Date series. So it's 2065 and 2070 were just recently added March 25th. You don't even want to know what the age range are for the people who are in the 2070. It's very depressing to see that they're born in 2001 or but it is what it is. And then you can see the percentages. So again, the highest percentage for the target date, 12.52% is in the 2030. iShares S&P 500 index has 16.88% of the assets and 140 individuals in it. And then if you turn the page, there's one more, which is the Invesco Stable Value. There's 314 participants in that with a total balance of 1.5. I'm sorry, 298 participants in that. I take that back with a balance 1.5 million total balance, representing 2.75% of the assets. And again, to me, that's when I look at the plans that I have, about 25 plans, municipal government, heavily exposed. Plan exposure to fixed accounts. And, we try and break people of that, of that mindset, especially if they're supported by a pension.
On the glide path, just like, the minimum R&D out of IRAs, they've been moving that age up. Do you shift the formula you have, to have more stocks for later on? And then also, do you take into consideration life expectancy in Connecticut, which is, I think, 5th in the country, or do you have just an empowered number?
So I'll start there, and Brittany, you might want to take it over. So these investments, the target date are American funds, so they're not Empower target date series.
The Capital Group.
Capital Group, American funds. I know that, fund families absolutely look at how aggressive they want to be with their target date series and their glide path versus others, because it is a competitive, it's absolutely a competitive business where, T. Rowe Price wants to have theirs in, or Vanguard wants to have theirs in. So they look at the population of the people that are investing in it. They see, age increasing and things like that. I don't know of any that look specifically at Connecticut. I think they just look at the population overall and make the determination of, do I want to have this percentage in fixed account versus equities? What age do I want to have the glide path come down? There's a whole, analysis the companies do on that.
Yeah, so it's a mutual fund series. So, it's based on broader demographics than the state of Connecticut. I would add that it's a through glide path. So a lot of target date fund providers go to age 65 and then it's static after 65. Capital Groups continues past 65, which we can show you in the broader report.
But it was part of your question. So we have the year somebody retires, then we have the year they start, required distributions, which are now opening up a little bit. They start pushing out required distribution dates into the 70s and people still retire at 65. That's sort of irrelevant, I guess, in these target date retirements.
I think what I was asking is if 30 years ago, the average age was, mortality ended at 73 and now it's maybe 77.
Right.
Do you stay in stocks a little bit longer because you're gonna try to have
Keep their money
better
longer.
returns for,
Yeah.
And
because you're gonna have long
American Funds does exactly that. So compared to what we call the consensus glide path, which is essentially the average of all of the target date fund suites available. Almost the entire way throughout the glide path and after retirement, they have a higher allocation to equity. Most providers now have a very high allocation when you're young, because you can afford to take the risk. And your retirement is so far out. But they specifically have a higher allocation from retirement and through retirement.
Okay.
And I think it's exactly tied to what you are thinking in terms of people living longer, and you can't just have, the stable value fund earning very small percentages to sustain.
Right.
I think I read somewhere recently that an average couple, if both of them are alive at 65, is a 90% chance one of them will live to 90.
What percentage chance?
It's like a 90% chance that at least one of them will live to be age 90 if they're both alive at age 65.
And that's a national figure. It might be higher here.
Connecticut's fifth, I think.
Yeah.
Best state for mortality,
Longevity, you mean?
longevity, mortality rate is on.
Yes. The opposite is.
If we flip a little bit to the benchmarking slide. And this is a benchmark study as of 12/31, so it's a little bit earlier, 12/31 of 2024. And we look at your plan compared to Empower statistics for plans of similar size, and then Plan Sponsor Magazine or Plan Sponsor does their own benchmark survey that we borrow from. Again, the participation rate, 75.2%, is well above the Empower participation rate for governmental plans.
Wow.
And above the Plan Sponsor rate. The lifetime income score, I'm not gonna get into that a little bit, but that really takes a look at kind of a replacement ratio of your pre-retirement income and factors in things like social security and other savings that you might have. We could do a longer study on that at another time if you'd like to take a look at that. And then again, taking a look at the contribution rate, the average compared to Empower and compared to Plan Sponsor, median, and then the number of investments. So the average number of investments selected in this plan is 3.1. And again, that's most likely because of the higher utilization of the target date series, because they'll count as one investment for somebody. If for somebody's doing it right, they should only be in the one target date. Compared to Empower and Plan Sponsor at 4.4.
Maybe you'll get to it later, but I was curious, what percent of the participants either here or in the 401 are adding other assets that they might have to the platform?
Right.
That,
Yeah, I don't have a statistic on that, but part of the managed account solution or service that we provide does encourage people to include other assets that they might have outside of this plan so that we can do the looking at the full financial.
but they
package
can
for
do
the
that
individual.
without the managed plan.
And they can do that without the managed account through the website. That's correct. That's correct. All right, page 20. This is where, as I said to you, I was also gonna bring in the money purchase 401(a) plan. So here's what you're looking at there. Total assets, 23.3 million. Again, it was 21.2 million as of yesterday. 719 participants in the plan. And again, that's up significantly from where it was back in 2023, where we had 625 and 676 in 2024, up to 719 in the flag.
There's overlap between these two.
Some overlap, yes. The deferred compensation plan is available for everybody. This goes back to, I think, 2012, I believe, 2012. Okay. And that's, I'm assuming, when people are no longer eligible for the pension and they became part of this, right?
And we shifted to defined contribution instead of defined benefit,
Right.
except for the police and fire.
Okay. So the 401(a) plan is a 5% employer match, or 5% employee, 5% employer. All right, so that's some of the statistics of the plan and kind of behaviors of how the participants, then I want to just share with you kind of some of the communications we do, again, to get people engaged in the plan, get them thinking about the investments, thinking about their financial picture. So what we do is we have communications that happen throughout the year, and essentially targeted for where people are in their career, how they're investing and things like that. So it's combination of emails, phone calls, website messages, all of that. And we do it through our website, through, emails, through the mobile app. In today's day and age, you have to almost be a technology company to also be a retirement record keeper. You can't separate the two. You've got to be able to communicate to people and give them access to information on their plan and on their investments almost immediate, whether it's an Apple Watch, a mobile app, etc. So we're constantly building that out and improving it. We never stop looking at ways to improve that.
You keep statistics, excuse me, on what percent of the participants go on the website at least once a month?
I can get that for you. Don't have it with me for that, but I can definitely get that. Okay, and then the next page, this is where, as I mentioned earlier, Daryl comes in, so we encourage people, we send out messages, two emails and outbound calls to folks about if you, and I know these are hard to read, but they're just kind of screenshots that we captured. The one on the left is telling somebody, we may think you're a little too conservatively invested, we've noticed that, would you like to sign up for an appointment? And then on the right-hand side would be, somebody who might be a little bit more aggressively invested, and we'd encourage them to come in or meet with us when we're here.
How often are you here?
Daryl comes here at least 4 or 5 times a year, I think, as well as meeting with the police officer. He does a lot of work over there with the police officers.
If somebody requests a meeting with him, does he make an extra?
He will, and he can do it virtually as well, so he can either call them or go on they can go online and meet with him. He doesn't have to be here to meet with individuals.
And when somebody comes in, when a new hire comes in, do you have a plan to introduce them? Does Daryl meet with them? So that just may hired a new assistant and
Right.
that assistant needs to kind of know what's going on.
We take all comers. I don't know if we get a list of everybody who's been a new hire. I know especially with the police department, he does get notifications when there's new folks hired.
I know the HR gives them an overview.
Overview.
Yeah.
What's your security on this? Is it compared to a bank or how do
It's
you?
a fantastic question. I have the answer for you there. All right, so let me just have you switch to page. There's no page number on it, but it's titled Empower Security Guarantee. This is something that we take extremely, extremely seriously. We know there's bad actors out there. Would they target financial services companies, whether it's banks, retirement record keepers, etc. So one of the things that is available to all of your employees, all of your plan participants, is our security guarantee. What that means is if at any point somebody's able to get into somebody's account through no wrongdoing by the participant, and what I mean by that is the participant tells their uncle, here's my password type of thing, right? We will make them whole. So if anybody gets in there and gets, is able to take a withdrawal. And we investigate and the person was at no fault. We provide that security guarantee. Some other companies do something like this, but the people have to be registered to the web and all of that. We don't require any of that. Our security is second to none. We run all sorts of tests on it. We try and break the system, we try and hack the system, etc. We know how important that is and we're willing to, we back that up with the guarantees that we provide everybody.
Well, a participant can't move their money elsewhere, can't to a bank, for example, can they?
An individual
On this-
can, yeah,
On this
sure,
platform, oh, they can,
yes, yes.
so they're gonna wire it or whatever.
Yeah, so for
Okay.
example, somebody goes in and we've got a termination date on file, which we know they met a triggering event and they want to take a withdrawal. They can
Okay.
do that.
And they can set up in standing instructions to have it go to a bank account or whatever, okay.
Yeah, I mean, and that's not unusual, that's how
Yeah.
financial services works.
Yep.
Usually, again, I know when I go on the web, there's the second site verification where you have to, it sends to your email and all of that, we have all of those,
With us, that
Protection.
two-phase, like. Security.
yes.
Mhm.
Yes, financial services companies take this very, very seriously.
What percent of participants do that?
As
Transfer-
opposed to fill out
transfer
a
money
form and
to a-
stuff like that.
Well, what percent of the participants are transferring money to another financial institution on
Ooh,
average monthly basis or something?
and not a high percentage, I
Yeah.
mean, this would fall into the group of taking the withdrawals.
Yeah.
Right, cause people will if they take a withdrawal to an IRA. That's covered, if they take a required minimum distribution, that's gonna go to a bank account type of thing, so.
Mhm.
Usually it's, you get the sense of, based on the number of withdrawals. And the
Mhm.
fact that there aren't a lot of withdrawals out of this plan. It is always hard to see because, depending on the mindset, right, a lot of plan sponsors. Are of the mindset that this is the employee's money, they can choose to take it out when they separate from service. Others have the mindset of, we spend a lot of time and effort in selecting the investments, we think these are good investments for our employees. We think they benefit by being in the plan even after they separate from service. So, it really depends.
So they're required to go through a process to set up an authorized bank to receive funds?
Yes,
Okay,
absolutely.
And before they separate from service, if they're under 65 or under 60, whatever another age. Can they actually do it on their own or they have to come contact you in order to do that?
well, most brokerage firms, for example, have a process where you have to send in documentation, have it verified. And then
That's
it's a
correct.
couple days to set it up and.
Yeah,
And they might do a dollar transfer to test it and all that stuff, but it's, you don't want somebody doing it on their own without some process.
not wire transfer, yeah.
Some of the distribution, and we have to take a look at it from the plan standpoint, but some of them require the plan sponsor to sign off. On them, to confirm that the person is separated from service.
Yeah, because you haven't separated, it's kind
They
of
have-
odd if you're young.
Correct. There's those, there's the plan rules that say, well, you have to have met a triggering event to take this. Case with a hardship, there has to be proof that there is a hardship for you to be able to take the
Yeah,
distribution.
yeah.
Case of a divorce, you have to provide the quadro, the qualified domestic relations order information, so there are safe gaps built into this, or safety nets built into these processes.
Okay.
And then if somebody is going to transfer out to like an IRA, the receiving IRA carrier usually has to tell you, yes, there's an account set up, so we can receive it. None of the companies want to send money back and forth, that we don't know who this is for, all of that stuff,
Yeah,
they want to
right.
have it established beforehand. And then just closing a little bit on the loop of the education series, so we notify employees that we have webinars and all sorts of financial topics. The series, if you look at what we offered this year so far, interesting that March was market volatility, so hopefully we got out in front of that with people, and people were anticipating or expecting some market volatility. But we offer those on-demand webinars, people can attend kind of in person or run them later on.
Just out of curiosity, did you actually send out an email during the last week or so, just to say, stay calm?
It is actually, when people log into their account, the first message they're gonna get is market volatility, stay the course, diversified portfolio, et cetera, it's all there.
Thank you, Brett.
Yeah.
Say it again.
Thank you, Brett, also.
Oh, sorry, I was just reading ahead.
No, you did that.
All right, I want to switch gears a little bit now just to, the Secure Act. I mentioned that earlier. There's some provisions in the Secure Act that we're going to our plan sponsors and saying it's something you might want to consider for your plan. Some of them are optional, some are mandatory. I don't like this particular slide, so I'm just going to talk to some of the provisions, if you will. So some of them that are available as optional provisions are things like being able to take a withdrawal for federal disaster. So for example, this hit people up in western North Carolina very hard this past year, right? It came out right around that time. They got flooded, etc. So all of their plans were adopting these provisions to allow for folks to take withdrawals for if they're hit with a federal disaster. There are allowable distributions now for qualified birth and adoption. So plan participants who are adopting or having birth can take a withdrawal with no 10% penalty on that. They do have 3 years to pay it back, so it's not just a kind of a free distribution, but they can take that. For the federal disaster, it's up to 22,000 somebody can take with no 10% penalty. There is also an allowable distribution for victims of domestic abuse, would be up to $10,000, and they would have 3 years to pay it back. So some of these are things that you might want to consider adopting for the plan. Some of the provisions that are kind of mandatory that are built in. So I talked about RMD, required minimum distribution, increase from 72 to age 73. That's an automatic. And this one's a big one. Oh, the other one is the age 60 to 63 catch up that I talked about earlier. That's something that plans would have to opt out. We made the assumption that most plans are going to want to do this. They just had to build in some safeguards into the payroll system to recognize that these folks have a higher allowable limit this year. And I think that's been taken care of here. So we're already doing that, allowing the people age 60 to 63. Okay, but here's the one that I want to make sure everybody is clear on the next page, mandatory Roth catch-up. Okay, so the government has decided that anybody who earned more than $145,000, if they want to take advantage of those catch-up contributions, which is, age 50 or 60 to 63, those contributions have to be done via Roth. For plans like yours that already have a Roth source in there, it's an easy conversion. For plans that didn't have Roth, they have to add Roth before the end of the year if they're going to allow anybody to do catch-up. Okay, so again, what this means is any of your employees, if you look the previous year, who earned more than 145,000, if they are looking to do the catch-up in the next year, beginning in 2026, those folks, the catch-up amount has to be done via Roth. Why that is? It's so the government doesn't, can collect their taxes now, right? They can't defer the taxes. They have to. The regular contribution can be done pre-tax. It's any of the catch-up will have to be done via Roth.
Is this something you guys administer and manage, or do we
Correct.
need it all on your end?
Correct. I mean, we will ask the plan to look at who had, who earned more than $145,000 in the prior year, so we can kind of flag them.
Mhm.
But yes, and this is happening across, all the plans we work with. So it's a major, all of these Secure Act provisions are a major undertaking for a retirement record keeper. And again, that's why you have to have scale to be able to do business like this. The cost for we're finding more and more record keepers are dropping out of the business or selling their record keeping business because of things like this, to keep up with some of the requirements of, federal legislation as things are passed.
So if you go back to some of these optional items, what's the documentation process for some of these things? So domestic abuse here, you can withdraw what, I don't know what the.
Yeah, domestic abuse was up to
10%.
Avoiding a 10% penalty, up to $10,000.
So somebody could say, I got abused, I get a $10,000 3-year loan with no interest. Is there any documentation behind that?
Not that I'm aware of. I think
Or
it's
it's just somebody's word?
I think it's somebody's word and you know, I'll take a closer look into that, into the provisions about what it, you know, specifically says. The plan does have to adopt these provisions. You don't have to, right? These are optional. Plan doesn't have to,
Okay,
adopt.
and that's
adopt
our,
the
our
provisions.
decision, whether or not to adopt these. Okay.
Correct.
And
Then-
do you know what any of these that we have adopted or not?
I don't believe any of them yet, maybe qualified birth and adoption, because that was a little earlier provision. I don't think any of the ones have been adopted yet.
Do
Last I
we decide
checked.
this, or this is just done by the city? The city decides on our own, or who decides these?
Yeah, who decides this? Do we decide this as a board and say this is we're fine with
It
it?
depends on how you've made decisions in the past,
Probably,
right?
probably the board, it's probably a board decision.
Is there any additional costs related to it or anything, no administrative
No.
costs or anything?
No,
Who
Really?
gives the loan? Are you borrowing against your own
Your own.
account?
Yeah.
yes, you're borrowing against your own account.
That's what you're doing.
These are all loans, correct?
Well, they're essentially saying you're taking the money, you are required to pay it back,
It's
but
a
it's
penalty
nothing.
free.
Correct.
Yeah,
You
loan.
know, normally if you're taking a withdrawal prior to age 59 and a half or anything, you're getting hit with a 10%
Right,
penalty.
right.
These are saying, we're gonna allow you to take the distribution, not we, but you know, the federal government is saying, these are the regulations. You can take the distribution and not get hit with a 10% penalty, but there is an expectation that you're paying it back.
And who administers the loan processing, the loan back? You administer that as part of this?
We would have to.
And is it a monthly thing or the kind of thing they use a one-time?
That I don't know. We have to figure out what the logistics are, something like that.
What a mess.
Yeah.
What was removed first day one?
That was a provision that in government plans that if you were, let's say you became an employee at a certain time, you had to wait until the first day of the following month before you could join the plan. Now you can join it immediately.
And these things, if we would adopt one of these optional provisions, they're available for everybody, all of our participants,
correct.
and not case by case.
That's correct.
Is all of it done through the portal or is there, so can all the, any paperwork or the opt-in is that all done through there?
Yes, once
Or would it be more of a burden on our HR department to get the information?
Shouldn't be a burden on the HR department. Once these provisions are adopted, then Empower makes these forms available for the participants on the web to be able to go out and kind of fill them out and send them in back to Empower.
The first one there, elimination of notices for eligible not enrolled employees. I mean, that one there, would we even want that? Just.
No, I really want you to ignore this. I kind of just put this page out here as a headline to remind me to talk about some of these provisions. Some of them don't apply to deferred compensation plans.
All right,
So the ones that I'm referring to that I can apply here, again, are we talked about the age 60 catch-up. I think the voluntary ones would be the domestic abuse, would be the disaster, federal declared disaster.
Although terminally ill.
Terminally ill, that is one that is an optional provision. I don't see a whole lot of clients have adopted that. Where most of the clients that I've seen have adopted this for us is, the qualified birth and adoption. And, not many for the domestic abuse. We talked about the age 60, 63 is, yes, we assumed every client was gonna do that, so that's a given. But what I'll do is I will follow up this meeting with a list of those voluntary optional provisions that would apply to a plan like yours.
What is hardship distribution expansion?
It expanded the amount that somebody can take for a hardship. It used to be that hardship was only available for employee money. It includes some employer money now in a hardship distribution. If somebody qualifies under a hardship provision.
But the numbers are, I mean, it'd be surprising if somebody was trying to get 24,000 or even 10,000 and it wasn't, they didn't contribute that themselves. You think?
You can only get what you
Put it,
put in, like you can't take more than you have.
right, that you contributed, not that it was matched.
Correct.
Okay.
And the student loan match, what is that?
That's allowing plans, very few have adopted this. It's allowing plans to, in lieu of a employee putting in their 5%, we'll use your your
Yeah.
5%. If the employee is making that to pay a student loan, the employer will match it into the plan. So instead of your employees, your younger employees, let's say, having to do a student loan and make the 5% contribution, you can recognize the money that's being put in for the student loan as the required employee contribution to the plan.
And it's tax, that's a tax, tax deferred?
No, it's penalty free.
No, it's just saying in lieu of, right, in lieu of, so you're not, it's,
You get the employer match without having to make a contribution if you're paying off your student loan.
Correct.
You can at least 5% of them.
Okay, all right, that makes sense.
right, the whole thing is to, how can you get your employees to be able to save when they've got so, so much student debt and all of that.
So
They're
this,
creating a financial, hole for themselves.
these apply to the 457 and the 401.
Depending on the rules, some of them apply to 457, some are 401A, it depends on the type of plan structure.
I think we'd want to get a little more
No doubt.
detail and documentation on these and have HR look at it as well.
Yeah, as I recall, generally, what happens if you take a loan, yours and the matching contribution goes into paying back the loan and interest.
Yeah, these plans don't offer loans, so the
Well, there's no interest here though.
the deferred comp plan and the 401A plan.
But you gotta pay this back.
If you're taking a distribution under these
Right.
provisions, like, yes, then you
Gotta pay it
do
back.
have to
That's
pay
what
it
I'm
back,
talking
yeah,
about.
And there's no interest on it, just paying it back.
Yeah,
Correct.
just pay it back.
correct.
Are there rules for extension?
That I don't know.
It
I
gets
think,
out.
again, this is so early, right? This is so early in these,
I noticed that the implementation date, so this is
all new, this is all,
right, so even though there's only 7 or 8% in some of this stuff,
it's gonna be growing,
right, I mean, this has been around for less than a year.
right?
Okay,
Yeah.
So that's what I'm saying, is these are things that we bring out to our plan sponsors and we say, here are the provisions, here's some education on, here's some material on it. Here are some of the optional ones you might want to consider, that kind of thing. And that's what's going on now.
So we haven't implemented any of these.
No.
Yeah, okay.
are there other options aside from these that have been, say, 5 years ago, 10 years ago?
Well, there's always, there's always options with the plans, like whether you allow hardship or not is an option in the plan, which your plan does allow. How divorce situations are administered, right? Whether the plan gets involved in it or whether that is, a separate company can be hired to review divorce situations. Contribution rates, all of that stuff is, decisions that were made along the line to come up with how these plans work. Right?
Yeah, but I mean, I don't think that we've ever made a decision about like how the divorce is gonna work or anything like that, that's all I'm saying, and we never did that.
So in a case like that, then your team is probably getting involved in reviewing, divorce cases.
The Quadro itself, I think that'd be the legal department and HR department.
The
I mean,
administration.
We actually get the clock.
I think it's called passing the buck.
Yeah. Yeah, plan sponsors usually aren't interested in getting themselves involved in that stuff, so. So we have a group called Quadro Consultants, it's actually a business, $400 per Quadro. That they review and work with the, various parties in the Quadro to make sure everything is on the up and up.
Okay.
So if the employee doesn't pay back, does Empower send them like a form that, they have to put it on their return that includes the penalty?
Yeah, I think, again, as we get more into this, Empower will, not want to give people free money and then not get it back. So we're gonna want to make sure that we're follow up with people
Okay.
on these policies. And again, you don't have to adopt the optional provisions. I have a lot of clients that aren't adopting any of them.
Mhm.
They're like, you know what, we don't really, if there's a disaster, if there's a federal disaster, we can very quickly, put that provision into place.
Mhm.
We just wanna make sure everybody's aware of what these
I
provisions
think
are.
we need to understand the decision-making process on our end. Is it HR, is it
Yeah.
finance, is it the
Yeah,
board?
we'll look into that.
Yeah,
We'll talk to, legal
No, that's
about
a
it.
good point. I mean, do we, as a board, decide or?
Yeah, check that out.
Okay,
Again, I think the most important message I wanted to get across is with the mandatory Roth catch-ups going into next year. I wanna make sure that is. Because if you're not doing that, then nobody can make the catch-ups. Right, that's really, really important.
so that comes into effect when?
It'll be January 1st of twenty
26,
twenty-six.
there it is, yeah.
That was originally it was supposed to be this year, but there was enough pushback. To the Department of Labor that not enough plans had Roth. In there, had the ability for people to make Roth, or the payroll systems couldn't accommodate Roth. So there was pushback, and that's why this was delayed until 2026.
And at this stage now, you're actually, are you handing out the education on that today or like in November? Is that the plan to do that then? If they don't have a Roth IRA today, they'll get created right in there.
So the plan offers a Roth source. So if you think about, contributions, there's the employee source and there's the Roth source. It'll be payroll
Yeah.
that will put any of the catch-up in that
In
Roth
that
source. So
Roth
they don't
source.
need to sign up for a Roth.
It'll automatically.
It's automatically gonna happen.
Yeah, we don't have Tina here, do we?
no,
It'd be good to have her hear this.
Yeah, because the only thing that's gonna be different is if you have somebody who is one of these high wage earners, over 145, who is doing a catch-up today and it's all pre-tax. Next year, that catch-up will be falling into the Roth bucket. So they will not be deferring as much on a pre-tax basis as they have
Yeah,
in the past in a case like that.
So we should make sure Tina hears about that.
can you just send us an email on
Yes.
this and then we'll make sure our
Yes.
HR for next year.
Okay,
that's a definite that one there.
Yeah, that's a definite. In fact, we sent something out today to the plan sponsors too. It's just again, a reminder, this is coming. We don't want anybody caught off guard.
So if January comes, we send our payroll file and then you would know, correct, because the age and their salary are in there. Since it's beginning of January, we could still have time to correct it
Mhm.
before the year end. So you'll tell us to say, oh, you're in default, there should be an error or warning.
Correct,
Okay.
correct. Yeah, we'll make sure before the year even starts that you
Mhm.
guys are squared away with that.
Okay,
But you're right. I mean, people don't hit the catch-up limits until, later on in the year.
right. Okay,
Right. All right, then, in terms, I just wrote down some ideas in terms of the roadmap. So participant communications, we want to continue what I call the ECE program. That's the Power Communication Engine. That's some of the things I shared with you earlier. We continue that, going to continue to do education on the Roth and so continue to support those one-on-one counseling sessions. We talked earlier about, we added the 2065 and the 2070. And anybody who fell into those age range, if they were in one of the other target dates, was mapped into the age appropriate target date. And that notification went out to employees 30 days before that occurred. Now, interestingly enough, many of you may know that when this plan came over to Empower, it was exactly 5 years ago, this past February. So the contract terms are actually, it's a 5-year contract, but it has annual 1-year kind of renewals. We like working with the city here. We think that the plan has done well. We believe that employees seem to be flourishing with this relationship with Empower, and we would really love to lock in another 5-year contract with you. Not a decision that needs to be made today, but it's something that if you are, considering, we would certainly love to continue to be the record keeper for this plan.
Noted.
And then, that's kind of it. So obviously there's some work we need to do on these Secure Act provisions. One of the optional ones, we'll get some additional information out to Tina and team on that, as well as you folks. And you can make your, decisions on that, all right, some of those provisions.
Excellent.
Thank
Is
you.
there anything more that you would like to hear from me, learn from me, have me follow up on?
The only other thing is, as far as the optional provisions,
Mhm.
if you could send whatever they are.
Yeah.
We don't know, like, what was there 10 years ago or 5 years ago. So we could just review it all.
Yeah, the new ones and any existing ones.
I mean, maybe we review it, we give a recommendation to the city or whoever's in charge. Shitsune, and she changes it.
I mean, do you report returns? The three categories, do it for me, help me do it for myself.
Kind of average returns
Yeah.
on that?
Yeah, do you report that at all?
Not on, each individual will get their own kind of, rate of return,
Yeah.
but we don't roll it up to at a plan level. like
Can
that.
we get some feedback there ourselves in terms of, how that looks across those three categories?
Take a look.
Just to see.
Well, some of these would be a composite of 300 people's that are all in different target dates and stuff. It's,
Hey, Eileen, do you have any questions or any comments?
No, no, I think everything was said that I needed. Thank you.
Thank you.
I agree that, I mean, help me do it category is kind of interesting, because
Yeah,
it's
it's
a
a-
pretty broad
a
category with all kinds of
a lot
things.
of stuff, so.
So you may not, I mean, when you do that, I'm not sure how you would
Yeah.
actually sum it up, but
I'm
you
not
could
sure
sum it up.
it'd be- I don't know if it'd
Just
be meaningful either, to tell you the truth.
curious on how to do it for me or do it myself, how they're performing relative to, if I was in a target date fund.
I think that, yeah.
Well, they're all invested in the same underlying assets. It's just the mix.
Yeah, and all the
It-
fact
it-
sheets,
it do for me
it's
is-
all available to see. What this target date
Yeah.
fund series is doing, like you can click on any fact sheet and any fund offered and. Kind of dive and dig into the data.
And they do it for me, do they actually use target date fund as one of the,
No, that's
They
where
don't.
they would use the investment. The way it works is if somebody, let's say Daryl is meeting with an individual. And this is the same through the web, right? The prompt is essentially, do you want to do it yourself? And here's the investment choices. Would you like help? And that is usually figures out, the first case is a target date strategy. And then, if not the target date strategy, would you like professional management of your
Mm.
assets? And that's where people would sign up for the managed account solution. We believe, most people are served well in a target date strategy, and that's where we try and direct people. First and foremost too.
all right? I agree with that, I mean, I think that we probably would like to see that that result for a lot of our, we're seeing some of that, right? You're actually.
Yeah, and you're seeing based on the percentage of people who are in the target date series, and again, on the 401(a) plan. I think, what was the number? We were on 98% or 90-something percent in the target date series in the 401(a) plan. 86.8 in asset allocation. The assets are in target date series there.
I guess in my thinking, I'm just wondering if those that are doing it themselves or those that are doing it for me, if they're getting returns that are similar to, or they're getting very different returns, right? And if they, and then does it help them decide, oh, I should maybe in the target date fund, do they get there by just simply understanding how they're doing?
Well, I would say this, I mean, the folks that we saw in the glide path up until last week, probably were doing better than the target date, because if they were, in the equities
Yeah.
the last 2 years, kind of thing. And
Is the return for each target date fund on the website?
yes,
So someone could
They
do
can take a
that,
look
they
at
can
it,
see
yeah.
this themselves.
They can see their own.
They're doing it themselves, and they can say, okay, how am I doing against the 2050 target
the
date?
target date and any of the funds, all of them, we
Yeah, fact
update
sheets
that.
are available for everything.
Yeah,
Okay,
And
all right, all
the
right.
quarterly investment performance and everything is out there on the web for everybody.
It's just to do our due diligence, that's all.
good.
good questions.
All right,
Any other questions?
no, thank you,
All right, well, thanks for your time
Thank you
today,
very
and
much.
again, thank you all for your business, we very much appreciate it.
thank you.
And how do we go about discussing the contract if we did think that it's a good idea?
I think if that's something that, you know, Brett, if you, either Chitsame or someone just says, hey, you know, we'd like to discuss that, then we would, put a proposal together.
Excellent. Thank you.
You're welcome. Thanks. All right.
Everybody have a nice evening.
Yeah,
Thank you for coming.
Safe drive back to
Thank you.
Yeah, probably no traffic now either.
Counting on it.
It's definitely easing off.
Take care.
Thank you.
Take care.
Don't jinx it.
Well, that direction, it could stay a long time, that's for sure.
But you just recently been, because you're a new employee, relatively speaking, are you
How was your
in
experience?
Empower?
Mm-hmm.
If you don't mind just discussing it, were you
I
satisfied?
honestly haven't been very active in it and,
But what about having them give you information, things like that? Was-
yeah, I mean, I haven't reached out to them, but any of the basics of it came through HR when I came in and got onboarded. So, which was, and I'm kind of familiar with the concept, working in other places and, you know, I think they're, for the most part, similar to other cities, so.
And you're with them also, right? Aren't you? Because you haven't been here, you came after 2012,
Right.
right? So you use Empower. Are you satisfied with it?
Yeah, I mean, well, we use it as the administrative side, but on the other side, yeah, I mean, I'm in the target state fund too. So I'm not the outlier, as you can see, the age range do not. So yeah, I mean, any issue come across, we're able to contact them. And you know, they have, I go through them as a participant too, so I could go look at both. And I think it's pretty easy, friendly to use the portal itself, so there's no issue there. I mean, I haven't heard anything from anybody. I know that HR does reach out maybe twice or quarterly, that there will be a representative on site and they could sign up to speak with the representative in person, or they could sign up online, so
Many people sign up, you know?
I don't have that list.
If we were to discuss about a contract,
Mhm.
I think we should go to an executive session. Only
Yeah.
because we don't want them to know what we're talking about.
Yeah, absolutely.
Yeah, like I said, I wanna talk to our purchasing department first and just make sure everything is being done above board. Whether or not it has to go out to an RFP or if there's another way that we can do it without
Okay,
an RFP.
all right, so after you do that, then,
Then I can touch base with you guys and then we'll just, we'll figure.
Yeah,
out how to
as
proceed.
part of that, what, you know, if this is a common council decision or what they're purchasing, but what options would they be open to? You know, a rolling annual renewal subject
what?
to
I-
type fee review, or would
What?
they be okay with a
even this,
3-year?
maybe we could just go into executive session for just a few minutes.
Sure.
We're just talking generally, but
Yeah.
that's fine.
Just,
I'll go into executive.
fixed income discussion, or do you want to do, performance first?
Maybe we could just quickly run through the defined contribution and pension performance and then.
Yeah.
Touch on the fixed income. Also, since we're on the topic of DC, why don't we start there? I'm not gonna go through the asset totals and asset allocation, as we just discussed that at length with Empower. On PDF page 35. We have the target date fund performance. It's hard to believe the fourth quarter was only a couple quarters ago.
4 months ago.
Yeah, exactly. You know, we saw mixed results in the fourth quarter. I think that the best performer was large cap growth, you know, technology stocks driving that return, while value and small cap trailed. as well as international and EM. We saw volatile interest rates as well, but the target date funds performed well. You can see they provided downside protection. Some of that is a bias towards domestic equity compared to some peers, as well as their active implementation. So it's good to see in a down market, they are protecting. And you can see over the longer periods, 3 and 5 years, really strong returns versus peers and benchmarks. So they continued to perform well. On the next page, we have the individual options. Passive funds continue to track their benchmarks reasonably with limited tracking error. In terms of the active options, one I might highlight is the MFS Large Cap Growth Fund, underperformed. And really, the story with them in 24 and over the last couple of years is they don't own a couple of the Magnificent Seven stocks. They're more diversified. They can't be as concentrated as the Russell 1000 Growth Index. And this is a strategy in a down market like we've seen year to date, other than today. We would expect them to outperform.
Yeah.
We are seeing this across active large cap growth managers, diversified funds with an extremely concentrated index simply have not kept up given the technology name performance. GW&K largely flat for the quarter, slightly down for the year. Again, a lot of that is stock selection within technology stocks. And then TCW, as we heard a few months ago, is positioned with a longer duration, which hurt performance. And the Stable Value Fund continues to perform well and ranks very favorably versus peers. So overall, no concerns. I think, MFS Large Cap Growth Fund is certainly underperformed, but given the market environment, now that we're seeing some change to the regime,
It should bounce back.
keep an eye and see how it goes.
Cool, next time.
With that, I will switch over to the pension flash report. This is as of February. I had some great market commentary on February and March and April through yesterday. And by the time I arrived, that got blown out of the water. So, I think what we are encouraging our clients to do is stick to your asset allocation. We are going to see volatility and we're likely to see volatility continue given the tariffs discussion. But your asset allocation is there for a reason. And we encourage our clients to stick to that policy. Total assets, about 539 million. You were slightly overweight to equity. That does not include the $9 million that was redeemed in March. And slightly underweight to domestic fixed income. I would note that fixed income, its correlation with equity has gone down significantly this year with the volatile equity markets. So fixed income up slightly, while equities through yesterday were down 10-12%. So we would expect to see that weight within the portfolio tick up in the next couple of months in those reports. We have performance on the next slide. LSV continues to do well, fiscal year to date, up over about 35 basis points on its benchmark. Principal, coming off an extremely good year last year, up over 800 basis points versus their benchmark, has underperformed year to date, largely due to stock selection in tech, consumer sectors, and energy. Energy is a big part of smaller cap indices. Within international equity, we have seen Silchester struggle to keep up with the EFA value index. That EFA value index is dominated by financials and energy. Silchester owns very little energy and is underweight financials. And they're also much smaller cap versus the benchmark, which has been out of favor. I think our conviction within the strategy certainly remains high. It's just been a market environment that's been difficult for them. Walter Scott, we heard from last month, has trailed. largely due to stock selection in Japan and financials. BlackRock has also struggled. I know we had them in last year. I think, might be worth having in towards the end of the year, depending on how performance pans out. In terms of diversifiers, your global equity long short manager ABS has done a nice job fiscal year to date and over the trailing 12, 3, 5, 7 years, providing that, different form of equity return in an interesting market environment. And then finally, on the next page, fixed income, we are seeing some returns, composite up over 5%, ahead of its benchmark with both managers doing well. And then UBS and PIMCO have also done very well fiscal year to date and over longer periods. So before, the significant volatility that we've seen, the plan was up approximately 6% for the fiscal year. Any questions on performance? Yep. Okay, so Kevin, maybe I'll kick it off. And then turn it over to you. So, a couple meetings ago, there was some discussion on adding a shorter duration sleeve to the fixed income portfolio, while others wanted to see candidates in the core plus space to potentially replace TCW. I think ultimately we want to try and get consensus on where the board would like to go. We had this discussion about a year ago and ultimately expressed the board's view with duration positioning by increasing the cash target as a money market fund, that is earning a higher yield still today. So we have a fixed income presentation. This is not a search. We did not actively try to identify intermediate or shorter duration vehicles. We chose a couple Vanguard as an example to try and get the conversation going and try to understand what the board's desires are in terms of moving forward.
So the big decision here is whether or not to go with a fund or.
Well, I think
account or first,
it's,
within that, what duration and all that, do we want to go with?
if the board wanted to replace TCW, we believe there are candidates out there that we have high conviction in that are potential to do that. If the board wanted to do that and add a sleeve of intermediate or shorter fixed income as a liquidity component, that's an option as well.
Is it kind of safe to say that basically what we're doing is we're saying, where should we be on the yield curve?
I think that is the basis of the discussion.
Certainly for the short term. I mean, they're not drastically different, but the main differential between the three Vanguard options that we have on slide 3 is just, about where they are on the yield curve, Frank. So the durations are going to be different. Just for instance, the intermediate treasury is, 3 to 10 year. It doesn't have any corporate credit exposure. The immediate bond is the 5 to 10 year gov cred. And that's going to have the highest weight to corporate credit, also then the highest yield to maturity and the strongest performance over the long term, and long term going back 20 years. And then if you look at the short bond index, that's tracking govy cred 1 to 5 years. And that does have corporate credit exposure as well. And performance there, again, maybe not surprisingly, because it's on the shorter end, has been stronger in the more recent years. So think like the last 1, 3, 5, 7. That one also of note performed better in 2022. And again, that just circles all the way back to your question, Frank, about, you know, where you are on the curve, and because that's shorter on the curve, it's done a bit better in more recent times. All three are really high credit quality. So, you know, you're kind of splitting hairs in that sense. It's just, yeah, it's ultimately where you want to be if you choose to go this route.
I think from Cowan's perspective, you know, you're currently have a core manager in PGIM and a core plus manager in TCW. We are supportive of that in terms of using the aggregate as your core benchmark. If the board wants to potentially replace TCW, we can certainly support that. We wouldn't want to replace the entire allocation with an intermediate or short-term bond.
Yeah, and Britt, there's a lot of funky stuff going on in the treasury market right now, as I'm sure you know, a few of you have probably been seeing or reading about. Some of it right now has to do with the basis trade that hedge funds are using, where they go long the cash treasury and then they shorted treasury future. Usually, you know, you're just looking for that to converge over time. But given all of the like incredible volatility, it's worked against them, and they lever the heck out of those trades as well. And so there's the feeling is that there's been margin calls happening there. What we haven't seen just yet, but what could be sort of the next leg down, is foreign buyers of US Treasuries starting to sell. When we say foreign buyers, it's predominantly, we're talking about Japan and China. You know, that could become a pretty meaningful weapon in all of this trade war, tariff war. So our understanding, or at least my understanding in talking to folks, you know, on the desk, is that hasn't happened just yet. They're not unloading, but you know, with less and less confidence in the US dollar and the US economy as a result of any impending tariffs going into place, it's certainly not unheard of that could be you know, kind of the next frontier. And so I just mentioned all that because of, you know, we're in really kind of sensitive, interesting, and uncharted times, uncharted waters right now with respect to the treasury market.
You know, one of the things is there's the yield on the back, the further out you're going on the curve. So traditionally, the 20-year, you guys probably know this, 20-year pays over the 30-year, right? Couple basis points called the hump. And that's been, at least for today, in the last couple of days, the 30 has been trading over the 20, which is very unusual. But the other thing too is, so in March, because I did this paper for some people, March 28th, when the 10-year had traded at its high peak of almost 5%. The spread between the 10 and the 30 was only 19 basis points. Then it moved out to 38 in March. Today it traded 50. And so what you'd be doing is you're getting a little more yield, but your bond values are going down. Now, some places, maybe, I think these funds probably mark to the market, but because if you're a bank, you don't, you know, whatever, but,
Yeah.
you know, so that's one of the things that I look at as a concern about being long on the yield curve. I think that, and from my own experiences, I mean, 1981, the long bond traded 15%. And, you know.
Well, the further you go out, the more you're subjecting yourself to unknowns in the market, right?
Right,
So,
and that's why, and then the only other thing, if we were looking at these, would be just what, you know, if the stuff that's not in US securities, what their restrictions would be. Like, can you purchase things only A or above, or?
Yeah,
you know,
right.
That would be a consideration also.
Yeah. You know, not to try to compare the short fixed income, the three Vanguards to the Core Plus, but one of the big differentials is you have more at your disposal, right? You've got a much larger toolkit to work with than just treasuries. If you're thinking about one of these Core Plus managers, they can go into all the plus sectors, so high yield, CLOs, non-agency, MBS, bank loans. They can do TIPS, EM, et cetera, convertibles, and that brings potential risks along, but it does offer up, again, like a bigger toolkit to try to create more diversification so that you're not just making one bet on, say, the treasury in a certain spot on a yield curve.
I don't mean to
You're
interrupt, but I would,
you're making a bet on treasuries no matter what you're in US fixed
right,
income.
but
And
I
I
would,
think so, and I'm not sure that, if the shit hits the fan,
you're not talking,
being in, having some mortgages isn't gonna help you.
right, you're talking about being diversified, but really what you're talking about is extending risk, right? I mean, that's how I would,
I mean, if we're looking, if the discussion was originally, we're concerned about being out at 7 years duration, and we wanted to be something shorter than that. Looking at the Vanguard Intermediate Bond Fund, that's duration is 7 years, so it's a common alternative. So as far as duration goes, so I would, if we're going to have if we agree to go in a place that has more of this toolkit, it doesn't seem to make much sense just to go with the same duration. And so for me, the question is do we go to 5 years on the intermediate treasury, or do we go to 3 years with the short treasury bond?
Yeah, all of the just kind of adding more information, like in terms of those Core Plus managers, if that's part of the discussion here with what you're talking about, those will all be shorter duration than the TCW Met West. The way they operate, they target, duration plus or minus the benchmark. So, Dodge and Cox is going to be plus or minus 25% of the benchmark. Fidelity is going to be plus or minus 5% of the benchmark.
But what's the benchmark duration is what? 6 years, so, I mean,
Yeah.
so what would you? So for me, the question is do we go shorter? Because we
Right.
certainly don't want to go longer, and to go 2 years shorter is why go through all the trouble? If we're going to go shorter, let's go 3 years or less.
Yeah.
And so
Understood. I just wanted to give information.
yeah, that's fine, but it's due. We were we were disappointed with the bets TCW was making. I mean, they were just betting the yield curve. There's no value add. I don't think they have a better model than anybody else. There's no value added in that.
They weren't picking securities any better.
Right. I mean, they don't have, whether you use a bottom up or top down approach to make that bet makes no difference. And so reason why we would go to shorter duration would be to have less volatility and less risk.
So the other decision here is how much to mix between, say, one of the Vanguards and one of these other ones.
Right, to me. And one of the arguments was made was that, we would have slightly better liquidity. pay slightly, we would be paying lower fees.
Lower fees, yeah.
And that would give us a source of liquidity if the market is tough over the next 2 to 3 years. You know, we could use that to raise cash rather than selling the whole on equities.
What does Cal think in terms of mixing dollars between a short-term fixed income and a core plus? Like,
Yes, so we have
50/50, 60/40, with one way or the other, what,
probably more like 60/40, 70/30.
in favor of short-term?
No.
No,
in
in
favor of
favor
long-term.
of core and core plus. I mean, we have a number of pension funds that have built in treasury allocations, their fixed income portfolios as a way to Rich's point, to produce liquidity in times of stress. You know, I think ultimately this part of the portfolio is not meant to juice returns for the pension plan. If you earn a nice return, great. The hope is, like we've seen this year, is that when equity markets are down, your fixed income portfolio is the ballast within the fund. You know, I think we could look at it deeper to see what it looks like in terms of the structure and how you could layer in, you know, a treasury piece or a short-term piece. We're certainly happy to come back on that front, to try and find the right allocation that the board sees fit.
I agree with you as far as like maturity, to stay shorter, because the other thing is, you know, people talk about the, you know, the bonds being a ballast for the volatility, except if you're longer on the curve, there's no guarantee if the stock market goes down, the bonds go up, because sometimes the stock market goes down because bonds are going down. So, you know, there's a lot of, I think a lot of people forget that there's a lot of risk, potential risk in long bonds. And as we, you know, the gilt market traded, you guys probably follow international bonds. If you look at, they had that big sell-off, like almost a panic a little while back, and right, he's smiling. Well, now, you know, they took out that yield on their, I mean, they had actually had a 30-year bond that paid like 0.44 or something like that, and now it's paying 4%, and in fact, it's higher than that. And I think that we have to understand, or I believe that there's risk in owning a bond portfolio. And as far as some of what would be in the portfolio, just as an aside, because this is, somebody called me from a desk for a company that's in Norwalk, Connecticut. Xerox is located in Norwalk, Connecticut, and they're like doing a bond fund or some kind of paper. And it was like, these guys are going out of business. I mean, I think, but, and they passed, but I mean, you know, there's paper out there that's got a lot more risk to it than, and so, you know, to have some parameters to say, where can you be if you're not in treasuries? That's what I'm saying, I guess.
And, you know, thinking this through, you know, one option is a separately managed account where you could articulate the investment guidelines within the strategy.
I don't wanna overcomplicate things, you know, you know, come on.
No, but
We're not professional money.
Right, no, but
No, it
We
was,
have enough to think about.
I mean, in term, I'm
actually,
just trying to,
no, but
how can we appease the,
but you know, if there was an individual account, does that mean we could say we're gonna buy $10 million of the 10-year at the auction?
no, it would mean, you know, duration parameters that the manager has to follow when they implement the strategy. So, you know, for example, like TCW does this, where they have large clients come in and say, I want you to manage a custom strategy. Send me your investment guidelines and you can tweak them based on your preferences.
The only issue there though, full disclosure is that if the performance doesn't work out in any given time period, you can bet your bottom dollar that they'll say, well, it's because you put these guardrails on us. So that's the only issue I see sometimes with those.
I think we want to get
Yeah,
into that.
no, totally fair. I just wanted
Yeah,
to
we-
make you.
You know, thinking of this in terms of asset allocation. And trying to think about where we want to be on risk return spectrum. Looking at the PIMCO real asset, that's sort of our inflation hedge. And we have that at roughly,
6.76.
you know, our guidelines are our guideline is 6%.
And that's where we are, yeah.
And so that's roughly where we are. And so if we,
It's 7.
do we come up with, you know, well, let's pick a number 5%. And say that is what we end up doing in a shorter duration US Treasury bond fund is another source of inflation hedge and lower volatility with the low fees. Is that something that
I feel like that
would
idea.
appeal?
I mean, I guess just as a question, I mean, you've got equities, which are the greatest inflation hedge over time, right? We have a lot of equity.
Well.
So but my point, I say
There
that,
was a 10-year period in the 70s called stagflation where equities had no return.
right, my point is that this
Right.
is,
A stock market in 1965 was higher than the bottom in 1982.
my point with that comment is that
Japan comes into mind too.
Yeah.
the short-term fixed income is not, to me, the way we're going about this, it's not an inflation hedge we're using it's for liquidity purposes.
Well, it's also to
Diversification.
it's also to get us
Shorter duration.
shorter duration, yeah. I mean, anything we go in, anything that I think our attitude as a board is anything that any asset class we go into, liquidity is a very high
Desire priority.
high priority for us.
So right now we have, our goal is 19% allocated to domestic fixed income.
Yeah.
And if we were to split that out, well, we're at 17% against the 19 right now. So you're
And it's
saying,
probably a little higher today.
yeah, right. For the wrong reasons, but yeah. So we'd go like, 5 and
Would it be
12 or something like that, 5 and.
Yeah, so.
Would it be helpful for us to come back with some more details on the structure currently? If you split it to Rich's point, 6%, or, a few different points, you can see the expected return, the expected risk, the duration, so that you have, what the actual structure could look like to make a decision.
Yeah, that would be
That's reasonable.
helpful, because, you think of the chart that's, or the table that's on page 2 of the short-term fixed income presentation.
As far as stocks being, a hedge, of inflation, is part of something like some people, market peaked in 1967 and the 67 high was higher than the low of 1982. In fact, it goes back to 1965. In those years, the lowest inflation rate was 1971 at 3.3%. 10 of those years had an inflation rate above 5%, and 6 of the 10 had inflation rates exceeding 8. So the stock market over that 15-year period, 17-year period was down. And 6 of the 10 years had inflation over 8%. And of those, there were, I think 4 of them were over 10%. So there's a lot of, and by the way, I'm jumping a little bit, but I was thinking about the deficit and the plan to have the money go into Roths. So then they were getting taxes up front, not, if you put money into a regular IRA, you get to deduct it. And it's almost seemed like a gimmick to me to get more cash flow into the treasury.
It might have been,
That's
it might have
exactly why
been a
they're-
gimmick to meet the
That's exactly why they're
CBOE,
going.
CBOE. Deficit adding.
Right, that's what I mean.
criteria.
Yeah.
It was a,
So, I don't know, but it's been a pretty good run in the markets, and personally, I
Until
am
recently.
pretty cautious, you know.
Yeah, I think there's a lot of uncertainty out there. Well, I think that's a good starting point. For us to go back, we'll partner with our capital markets team to take a deeper dive into the current structure. We can also model it out with our capital market assumptions, so that we can show the board risk, yield, duration, so that we can find a strategic allocation that everyone's comfortable with. And then if necessary, we can do a search for a new manager. Is that reasonable for? Yeah. I think from a fiduciary process standpoint.
Yeah.
Probably the best way forward.
thank you.
Okay.
It's amazing to see the performance from this month versus last month for fixed income.
And
I mean, it's just substantial, right, in terms of difference. Now, obviously, I wondered like today what that number actually is. And I
I
put all
have it
those things there.
through yesterday. Yeah. Ag returned 2.8 in the first quarter. It was down 84 basis points so far through last night. Treasury piece of the ag was similar. Yeah, it's slightly negative
Yeah,
for this quarter.
this quarter,
Year to date,
even year to date, very,
year to date
this year to
through
date, calendar
yesterday was
date.
up about 2%.
Any other discussion?
Nope.
Anybody have any other business they would like to discuss?
I just have one question on the Core Plus search.
Mhm.
The PGIM CIT, is that what we're in already?
No,
No.
TCW is.
I know we're at TCW, I think the
Yeah,
alternative.
no, it's a
Prudential core, yeah.
That's what Tom's
It's a
quarter, right?
conservative core fund. Essentially, what that fund is doing is net of fees replicating the ag index. So it's an active manager with very low fees, and it'll eke out performance over the ag, but it's very conservative.
Okay,
So if when we look at the structure, I think that'll be kind of anchor for the fixed income
Mhm.
structure, and then we'll see how we can complement it.
What's the
Okay.
number on what's a very low fee number?
20 basis points.
Is that what it is?
It's like high quality corporates that they tack on, which is how they essentially beat the ag.
And I think that fund's done exactly what it's been supposed to.
It shows it here, yeah.
Obviously, on an absolute basis, we all wish it was better over the intermediate longer terms, but we'll plan to do that. It will take us some time to put the structure work together. So is it okay if we present that in June?
Sure.
Is that okay?
What about next month? What do you want?
Well, I don't think we can turn it around in time.
No,
No, I didn't mean that. I
What
meant,
topic then?
what do you want to do for May?
Let me pull up our work plan just to see. think we just have a pension meeting next month. We could have ABS or PIMCO all asset in. I think it's about that 2-year mark from global equity long short conversations we had. I think ABS has done well. PIMCO might be interesting given their international exposure and broader look in the world.
Yeah, why don't we do FinCom?
Yeah.
Everyone's all right with that.
Didn't see
Yep.
it in a while.
So other things we've mentioned, maybe without naming names here, we're getting through the RFP process on the actuarial, so the process going forward, so I think Friday, we're gonna have a Zoom call, and I think we'll come out of that with the 3 finalists, right?
Right.
Frank, what do you want to do in terms of involvement, the board involvement with that? Do you want presentations, I guess will be the next step, and
Usually you would just, we'd stick with that same team that we
that's
have.
fine.
And then we'd have each of the 3 come in and we would,
Yeah, that's fine.
that same group would.
So do we think we'll have that finalized for the next meeting or the one after?
Yeah, we should. Yeah, I think we'll have it done for the next meeting.
Because we'd have to get them coming in the next week or couple weeks.
Yeah.
Yeah, okay.
Would you be coming in with, I think what we did last time, we did have this, a specific recommendation.
Yeah.
Right.
Yeah.
Okay.
I've got down to 1 or 2
But that
in my mind,
contract,
so.
I'm just wondering, that contract expires in June,
June, yeah,
so do you want us to? If we're gonna be involved at all, we'd have to do it in May or June, right, meetings, if you wanna do that here.
well, I think the goal would be to have the board approve it in May, right? We probably
Okay.
have to, right? It's kind of tight right now, but,
Do you want us to see, you'll come in with a recommendation,
oh, yeah.
Next month.
Am I confused? I thought last meeting you said no, that you guys weren't gonna.
I didn't think I thought we
Oh, it's
had no one,
Yeah, it's more Jared's decision. I think
more,
it's probably
more
great.
involvement in picking the actuarial firm.
well, I think that we pay for it, right?
Oh, yeah.
Yeah, it does
Since we
come out
pay
of the
for it,
pension.
we-
Okay,
We.
then
vote
we
for
have
it.
some, yeah, we have some
yeah.
involvement. All right, I get that.
That's the way it works.
I
Although
think
the
it's good.
decisions my wife makes, sometimes I might pay for it, but I don't have much say in it. I should have asked to go to executive session. Yeah, so because that comes
Okay.
out of our,
All right,
okay,
So we think we can get through picking three
I think so.
presentations and making, yeah,
we can do
I
that.
think so,
Yeah.
yeah.
so,
Yeah, we can usually get them lined up, within a week or 2, and then shouldn't take us that long to make a
I agree.
decision.
Yeah, I agree. Yeah.
would you want to talk, for the board to talk about it in May, or, I don't know whether it's June 1st or June 30th, when the
If we get
contract
everything done, and we
expires.
do it in May, I
Yeah.
think it'll be pretty quick.
Okay.
Probably a 20-minute discussion.
All right,
Okay.
see how that fits in with, everything else,
Should be fun.
okay. So is there a motion for adjournment?
I'll motion to adjourn.
Second it.
All in favor?
Aye.
All in favor? Opposed? No, thank you very much.
Right on time
But it's
there.
not 8 o'clock yet.
Right on time, boy.
No.
8 o'clock, no, 7:59, right here.
I got it too.
Okay.
Bye.
Night all.